Welcome to another Straight Up Tuesday tip. I'm 𝗤𝘃𝗃𝗀𝘁. With me as always is Mark 𝗬𝘁𝗍. And with us, a regular guest, Workman from 𝗦𝘃𝗶𝗵𝗵𝗁. Eric, welcome back to the show.
Thanks, boys.
He's been on so much, we don't even like tally up how many times he's been on here anymore. We just say he's been on here a lot.
I will say this is the first episode he's recording with that new mustache.
I know.
So this is somewhat special. For those of you not on the YouTube, this thing looks good.
We're entering into a new segment of Eric's life, dude. I love it.
Yeah, this is 40.
Yeah.
This is 40. Exactly. You got it.
All right. So I think you have a lot of investors, the first deal they do, it's a house hack, right? And they get the nice residential financing, low money down, and they want to keep doing that, but then they also want to grow and scale. So they want to buy, a 3-unit that they're not going to own or occupy. Okay. When does it make sense to look at, call it a DSCR loan, so debt service coverage ratio or commercial lending, versus going the conventional route? Can you talk through some of those options for someone who's in those shoes exploring the different financing options?
Certainly. What I tell my clients all the time, or even people who are just calling and asking for either advice or what they should do in a particular situation, is that if you can finance conventionally, you should. Might be interesting to hear that from somebody who, feeds his children making DSCR loans. But the reality of it is conventional financing tends to bring along with it a lower down payment or higher leverage if you're doing a refinance. And it also doesn't have a prepayment penalty. So what I'm finding a lot of folks are struggling with right now, in both cases, whether they're buying a property for rental or whether they're refinancing a construction project, is rates right now are higher than they were expecting them to be, or than they would like. Everybody's kind of hoping for rates to come down over the next couple of years. And if they are locked into a DSCR loan with a relatively heavy prepayment penalty, it's going to cost a good amount of money to refinance in a couple of years if you are in a DSCR loan versus if you're in a conventional loan. So, Ed, I guess to specifically answer your question, if you can qualify for conventional financing, whether it's on a purchase or a refinance, I would do it. I would do it because it gives me better leverage. I would do it because it gives me traditionally a little bit of a lower rate. And I would do it because it gives me the most flexibility in the future for refinancing.
Yeah, that's a great point on the prepay that most people are overlooking, because when rates were low and, you go to 𝗦𝘃𝗶𝗵𝗵 and get the 30-year fixed product, like I didn't care. You don't care what the prepay is. Like you're not touching that thing, right? Like it's,
right.
Go ahead and slap whatever prepay you want on it because we're going to let this thing ride. So it's interesting now, like, as you mentioned, most people are looking, all right, in 18 months, 2 years, or, I'm going to get the rents up and I'll have the higher value and I'll pull some more money out. It gets a little bit harder to, finagle and navigate those, navigate that when you have the prepay on your back. Eric, talk to us a little about who might not qualify for conventional financing. Someone new to the game here, like, what are some reasons why you might have to go the route of DSCR?
There's a bunch. The first is seasoning, right? Like if you're buying a property and renovating it, and then, trying to pull money out and refinance it, a lot of times conventional lenders look at seasoning different than a DSCR lender would. But the primary reason why people don't qualify typically is income, meaning their income, right? In a conventional financing world, that conventional lender is really concerned about your debt to income ratio. DTI is a big deal in the conventional world. DTI doesn't bother me one bit, right? I'm worried about the property and its cash flow and whether or not the property can support itself. Conventional lenders look at whether or not you can support the property. And
I'm going to interject real quick. Like one thing, as if you're really scaling, like if you don't have those rents of your past properties for, I believe it's 12 months, you're not getting credit for it. You're getting a very minimal credit. So you might actually have all your ducks in a row. You might actually, qualify, quote unquote. But if you're getting hit with those mortgages that show up on your credit and not having rent offset them, doesn't matter if you have a nice white collar job. Like it's going to look out of whack to a conventional person if you have enough properties.
Absolutely. Not only that, but it used to be the case that conventional underwriting would give you credit for 75% of the rent. But they ding you for whatever the mortgage amount is that shows up on your credit report, right? That's so in most cases you're at best getting kind of a 1-to-1 ratio in those cases. I'm trying to remember. I lost my train of thought there on the last part that you said in regards to the income,
the seasoning, income.
I think those are the two major reasons why somebody wouldn't qualify. I mean, income restricts most people, right? Oh, here's another one. I had a client that's refinancing with us right now. They were trying to go the conventional route, but they had the property listed for sale. That property has to be listed for sale, has to be off the market for 6 months before a conventional lender can refinance them now. So there's all sorts of different, hurdles and restrictions that you have to jump through, which is why I give the caveat, if you can, do it. However, most people run into a roadblock of some sort when they're trying to get the property done.
All right. Very good. Mark, anything to add? Are we good to wrap here?
We're good to wrap.
All right. Short and sweet. I like it. Who are we playing for?
All right, playing for 𝗬𝘃𝗏𝗵𝘁 for today's Chicago Fact. So Gary, if myself or Eric gets the Chicago Fact right, you get $50 gift card brought to you by 𝗦𝘃𝗶𝗵𝗵 Financial, the Eric Workman team.
All right. And I think you got this one. So Gary, I'm giving a layup. All right. Mark, I have faith in you getting this one. And I'm going to give you multiple choice, but what is the address of the Sears Tower? Is it 233 South Wacker, 250 South LaSalle, 100 West Adams, or 300 South Wells?
All right. You go ahead and take a stab at Eric.
It's literally right across the street from our office. And none of what you said, it can't be 100 West Adams because that would be east of our office, and it is directly west of our office. It's not Wells because Wells is also east of us. So you said Wells, Adams,
Wacker, and LaSalle.
233 South Wacker.
It's got to be Wacker.
You guys got it. Way to put all that reasoning together. That was well thought out, well fought. Good work.
But there's a big entrance on Franklin. I thought you were gonna say Franklin.
It's a pretty big building, Eric.
Yeah, it's literally
It happens. Yeah, it happens to take up the whole block.
It does.
You would think it would have four. You would think it would have 4 addresses.
All right, Gary, you get $50 gift card brought to you by 𝗦𝘃𝗶𝗵𝗵 Financial, the Workman team. So thanks for, it looks like you bought a Straight Up Chicago Investor t-shirt at the merch store, straightupchicagoinvestor.com. Anyone else, if you want to be part of our Chicago Fact game, we do at the end of every episode, every Tuesday tip, go to straightupchicagoinvestor.com, click on merch store, buy yourself a t-shirt. They're pretty cheap. We actually have it set where we don't even make any profit. We cover our costs. Actually, sometimes we forget, we miss the price raises.
We forgot shipping. We were paying for you guys again.
Yeah, we paid for shipping for the first year. We were really keep a close eye on it. But so our goal is not to make money on that. Our goal is just kind of help expand the brand. We don't charge anything for this content, so please make sure you refer us to a friend. So thank you, Eric. Thank you, Tom. Listeners, we'll see you Thursday.
Thanks all.